Hi, I'm Bella Avila. I'm an editor on NerdWallet's investing team. And if you've landed on this page, but you would prefer to hear someone talk about the concept of investing rather than read about it, I've got you covered. When you first decide you want to start investing in stocks, it can be hard to know where to actually start. I definitely had to do my fair share of research before graduating from investing in a target date fund in my 401k to DIY investing. And very quickly, I do want to mention that I'm not a financial advisor and this is not financial advice. And before we dive in, I also want to mention a prerequisite to investing in stocks, which is that you'll need to open an investment account if you don't already have one. Two common types are a brokerage account for more general investing or an IRA for retirement investing. After you've opened and funded your account, which if you're not sure how to do this, we do have a link in this article on the topic, you can start investing in just a few steps. So, your first step is nailing down what it is you want to invest in. When most people Google how to invest in stocks, I imagine they're probably thinking about buying shares of individual companies like Google or Netflix. While it's possible to build a diversified portfolio by picking and choosing individual companies, that approach requires a lot of hands on research and ongoing oversight. As someone who writes about investing for a living, I'll be honest and say that I still don't feel confident enough to do that. So it might be worth looking into other options, especially if you're just starting out. I'm personally a big fan of stock mutual funds, which combine a bunch of stocks into one investment. By spreading your money across hundreds or even thousands of companies at once, you avoid investing too much of your portfolio in one asset or industry while getting some exposure to the companies you want to invest in. Index funds and exchange traded funds are two types of mutual funds that track an existing stock market index, like the S&P 500. I tend to lean toward these since they're passively managed, and in other words, that just means an investment manager isn't picking stocks for the fund, and that tends to keep costs pretty low. But you don't necessarily have to choose between individual stocks or funds. Maybe your portfolio is mostly mutual funds, but you want to dedicate a small portion to individual stocks, and that's okay too. After you've decided what it is you want to invest in, the next step is to set a budget. There isn't too much explaining to do here since everyone's budget will be different, but there are a couple of things you want to think about. The first thing is the share price of the stock or the ETF you want to buy. This will act as your minimum investment unless your broker offers fractional shares. Fractional shares let you buy a portion of a stock in whatever dollar amount you'd like, which can especially be helpful for beginner investors or if you already have a specific budget in mind. So, say you want to buy Meta stock, which at the time of recording this is close to $600 per share, but you don't want to blow your whole investing budget on just that one stock. Fractional shares allow you to buy maybe $50 and still get exposure to Meta's performance. This is possible with most brokers these days, but not all of them, so that's something you'll want to double check. And you'll also want to think about how much of your budget to dedicate towards stocks. This is largely dependent on how long you plan to stay invested in the market. If you don't need the money for a long time, the majority of your portfolio could be in a stock mutual fund with the rest in a more stable investment like bonds. The third step to investing in stocks is mental. You don't want to react emotionally to how your portfolio is performing. Some days will be up and some days will be down, but that's just part of stock market investing. Many things, from geopolitical tensions to economic uncertainty, can affect your portfolio's performance. But so long as you're in it for the long term and your investments align with your goals, there's no need to buy or sell stocks in a panic based on natural swings. Making regular contributions, no matter what's happening in the market, and letting compound interest do its thing is what long-term investing is all about. This leads us to our last step, which is to manage your portfolio. You'll want to assess whether your portfolio makeup still makes sense for your timeline and rebalance as needed. For instance, if you're investing for retirement, as you get older, your portfolio may shift away from stocks and more toward bonds. During this process, you'll also want to make sure that you're not too heavily invested in one specific sector or industry. The goal of this check-in is to make sure you're maintaining a well-diversified portfolio that works for your timeline. So, to quickly recap these steps, investing in stocks can be boiled down to deciding between individual stocks and mutual funds, or investing in a mix of both, setting a budget for your investments, staying focused on investing for the long term, and revisiting your portfolio as needed. If any of this feels a little bit overwhelming, don't let that scare you off from investing entirely. I'll also plug robo-advisors as a great option for beginners. For a small fee, you get access to automated portfolio management that takes your risk tolerance and time horizon into account and rebalances your portfolio for you as needed. Whatever avenue you choose, I hope this guide was a helpful resource.